Yeah, Zoom says we're live.
Yeah, and here we go. Here's the button. I've just clicked go live onto YouTube. So turns out I didn't actually put anything out on this today. So don't know how many people or if anyone will rock up, but
no, so nobody's going to rock up. Well, why don't we just tweet it out right now?
All right. For those of you that are listening to this podcast, we're just making this up as we go along, and let's do a bit of a tweet. So we're just going to say, if you're on Twitter, come and say hello. I'll just pop this up. In the meantime, I've got to remember to do a disclosure. I didn't do this last time, but disclaimer. If you're listening to this, or you're watching this as live stream, just remember that anything that we say is limited to general financial information only. And if we answer questions, it's just us just answering general questions. We're not answering it specific for people. You've got to make your own mind up. You've got to read the PDS, and past performance is not indicative of future performance and all that. In the meantime, while I tweet this out, mate, how are you going? How has your last week been?
Oh, last week has been great. A bit crazy, because we work on our recommendations, that are going to go live October 1. So a bit crazy doing presentations, or stock pitches as we call it. And then, working on the write-ups. Before that, doing the research to, make sure that, we're picking the right ones. So it's been a fun, busy week. But yeah, nothing special. We're in lockdown like you, so there's nothing much happening otherwise that I can comment on or report on. How about you?
Yeah, it's been really nothing new this week. I think because it's a shorter week here in Victoria, we've got the grand final this weekend. We've had a bunch of really interesting interviews. So a few interviews that are coming up on the podcast. I interviewed a woman by the name of Tanya de Jong, who is she's founded 6 businesses and 3 charities, and she's got this really interesting backstory, and she's focused on mental health, which is kind of prescient. And it's just been really interesting and good to chat to her because she has insights. She's actually a qualified lawyer and was a semi-pro tennis player, and she's an opera singer. So she's just a bizarre and wonderful person, all in one, and it's just fascinating. So just been chatting with really interesting people like that. I've had a few discussions with CEOs and that type of thing this week, just small cap CEOs. So we're just working through them. I don't know. I find that sometimes interviews with CEOs and management teams, you can come away with less conviction. Sometimes you can come away with a lot more, and it's really hard to anticipate in advance. I don't know if you ever had that kind of takeaway. If there's been a trend there.
When I used to do small caps, Aussie small caps, I used to do a lot of interviews and things like that. One of the things that I found, here's the thing, right? If a CEO is a really good salesperson, you come across really impressed in that meeting, right? They'll basically they should be able to sell you anything. And in which case, how do you make a judgment out of it, right? So my take always with the CEO meetings was, one of the primary reasons I wanted a CEO meeting or CEO or CFO or someone to meet with me is to basically just fill my holes in understanding the business. And this is because unless you're in an IPO, recent IPO here on the ASX, right, you don't really have a report that describes what the business is. So you're kind of having to make out the business by looking at some past transcripts or going to the conference calls, but you still don't get a good picture. So after you've done your research, I figured that the best way to understand the business was from the horse's mouth. And that really, really kind of helped. But yes, I was always circumspect of the fact that, if they're the best salesperson is on the job, then they're going to sell you the company. So
Did you ever come into, or have you ever gone into an interview with the CEO with a lot of conviction, and then come away from that thing, no, this is just a deal breaker, that my kind of gut feel was enough to try and completely just 180 that investment idea?
No. So, and that has not happened to me, largely because I'm a very skeptical person to start off with, right? So it actually, so maybe if you are at that position, maybe you're more open-minded. So I'm saying what the position you took is more open-minded, because I will start off being very skeptical. And then if a great salesperson actually gives me a good sales pitch, I'll actually probably be convinced that, hey, this is a good idea. So, it depends on where you start, and it's maybe being ultra positive is probably a good place to start than being, skeptical. I've always been skeptical. The other thing I found is even if you look at a person's track record, right? I mean, if somebody has a successful track record of business, unless they've done it multiple number of times, really doesn't, if they've been successful in the past, doesn't mean they're going to be successful again, right? I mean, one thing worked out doesn't mean that the second one is going to work out. Yes, if they have been they're like a Bevan Slattery, then they maybe have some magic, right? That's a different matter altogether, right? So serial entrepreneur is different, but it's very difficult to make out otherwise. I found it good for plugging holes.
Yeah, and I think it's as a fact find, it's also interesting. But I feel like you like, as you said, you do need to have your wits about you before you go in, because if you don't, then they could just pull the wool over your eyes. So I'm the type of person that likes to, I don't think you can truly understand a business as well as you would absolutely want to before you buy. I find that you often just discover things over time. And so repeated meetings or just not even meetings, just hearing and what they have to say, watching their webinars and whatever, seeing their consistency is actually a valid way to kind of gauge their track record if they are, as you say, new. I often find it really interesting when we talk about like successful CEOs and managers, because oftentimes we parade the person that is super successful with one idea, and a lot of that is, I'd say a lot of it is circumstance, and so, or it can be circumstance, probably the right way to frame it. So sometimes that's going to happen. And we can't pay too much attention to any one kind of strategy or kind of vision roadmap. That repeated success is really important. And like Bevan Slattery's had that, right? So he's got like Superloop, Next DC, Spotted Megaloop, all that stuff. Like he's in.
Like, I mean, it's really hard, and it's all in adjacent areas, but I mean, it's really different things, right? So Superloop, Megaport, as you said, Next DC, they're all kind of networking sort of things, but they're not necessarily the same thing, right? And then Slattery's also got investments in other areas that he makes, right? And what we need to remember there is that, I guess, what might look like a big position in a small company is probably peanuts for Mr. Slattery, because I mean, he can afford to, put his money in multiple bets, which is something very interesting. So but I admire Slattery.
Making a few thousand, he's making maybe a few million. So
I admire Slattery. I mean, Slattery is really like the sort of the Elon Musk equivalent in Australia, right? I mean, there are very few people who have done that many number of gigs in different areas. So I admire him.
Hey, before we get to the formal topics, which are going to include things like when we sell, why we sell, talking about some topical things like tapering and what have you, and also how to identify, winners in growth industries. People will probably see that you've got a T-shirt on there that looks interesting, and you were telling me today that it's a very special day, and I'm bringing this up because you brought up Elon Musk.
Oh, it's a special day because so this is my Cybertruck T-shirt. I have a thing. I have to buy something from Tesla every quarter. So because I didn't make a big purchase this quarter, I didn't buy a Powerball or something, so I bought a T-shirt from them. So I put it on actually today for our podcast recording, and those people who know, so this is a shout out to Tom Richardson. He used to work with me, and now he's a reporter at AFR, so Australian Financial Review. He made me a coffee mug, which basically has got an Elon Musk tweet on it, which says, "I'm considering taking Tesla private at 420, funding secured." This is the famous funding secured tweet.
Yeah.
He made, it was really funny that he made this. And I regularly have coffee in this because I am so happy that the company did not go private at 420. This is before the split. I have coffee on this, and I just laugh at my good fortune, and that I enjoy, and I remember Tom every time I have this. Yeah, I was happy because I had these two Elon Musk things on me to start, and then I got this email that said my Starlink can be shipped within 3 days, or if I want it sooner, then I can pay for it now, which I just did before we started recording. And I'm excited about that because my internet here is really horrible because the NBN got botched up to the point where basically it is, it's fiber to the curb, and then from the curb, it basically depends on what sort of copper wire you've got. I can't get more than 20 Mbps here. So the NBN site would suggest that I can get 100 Mbps, but I can't, and that's the download. I can get maximum maybe 25, and I actually pay, I actually can maximum get 28, and to get the privilege of 28, I actually pay for 60. So I pay at the 60 slab or whatever, the 50 slab, so that I can eke out a little bit more. Yeah, so the reason I'm excited about Starlink is that potentially I would be able to get maybe 100, 200, as downloads, and that should only increase over time as they put more satellites up. And I should be able to get maybe 50, 60 as upload. That changes the game for, if you're doing gaming, it'll change the game for gaming, but it'll change the game for many of my, sloppy internet connection issues that I have, and eventually maybe I can disconnect, I can say bye-bye to my NBN connection. So, yeah, so, a little trial for a few months, and maybe bye-bye NBN.
So just for those people who don't know, Starlink satellites put into space that some people can see, they say, with their naked eye just by looking up at the stars. And as someone who gazes at the stars, and I have my telescope right here beside me, yeah, it's an interesting thing because they've had to make changes around how kind of the light reflects off the satellites as they pass by. But I've also put down a deposit because I think the way that you get a Starlink kind of router is that you have to pay, well, they ask you to pay an upfront deposit, and then they say when it's available in your area, then you can pay the full freight, right? Is that how it works? Because that's what I've done. I think I've paid $130 or something.
That's right.
Yeah. And
yeah, you pay a deposit, and yeah, and then you see right now I'm getting my internet connection is unstable.
Yeah. Ironic. Yeah.
So ironic. And I can see on Twitter that people are, saying, "Oh, but in Brisbane, and we get this much, and that much." Well, I don't get that much. If I did, I wouldn't order it. I'm not dumb. But my internet connection is literally unstable at this very moment. So, yeah. So yeah, I think you can get high-speed NBN if you're in a proper metro, where metro is probably inner city. I'm not really in inner city. I mean, near in the Camden area, which is like 60, 70 kilometers from the city. We definitely don't get. In my previous place in Campbelltown too, I did not get. I could hardly get 30 Mbps. Yeah.
So. Yeah, right. I get reasonable internet, but I figured this is one of these things where as investors, I like to just keep tabs on what's going on. And I think if I can get it and try it out, see how it impacts my life, maybe then I can use that as kind of like an inference of what it could be doing for other people and other businesses, not even here in Australia, but around the world. And so for me, it's kind of like a low cost test of if, Starlink is actually a valid way of getting internet and reliable, like low ping, all those things, then why wouldn't more people do that and switch away from other devices? And what does that bring for certain companies and opportunities in that respect? So really interesting. I'm keen to know how it goes. So be sure to let me know. In terms of news topics today, mate, one of the things that you brought up before we hit record is tapering might happen sooner than people think. So maybe you can just kind of back this out a bit for us.
Yeah, so the Federal Reserve has a bunch of Federal Reserve governors, so they're the regional governors that make up the Federal Reserve, and then they all make what's called a dot plot, which basically is a prediction of where they think the interest rate is going to be in the future. And it looks like what's happening is that there's now anticipation that some number of people, at least half of them, probably think that there's going to be an increase probably later in 2022. Right, which is a little bit earlier than I guess anticipated. So I think the what I think the Federal Reserve basically is saying is that the recovery has happened. And according to Powell, the job recovery has also happened. While it's not as low as it was pre-pandemic, they think that the job recovery has mostly played out. And now there's inflation, which is also running hotter than they had expected, but they expect it to cool down, which means that it's now time to start taking away that punch bowl. So nothing unexpected here, but I think, a little bit of movement, towards, so I guess in my only takeaway was during when a crisis is unfolding, and these are like predictions, right? And their predictions are just good as my predictions or your predictions, right? So because nobody's very good at making predictions, but when people are making predictions at the depths of despair, then you tend to be pessimistic, right? And when you're out of the depths of despair, you tend to be optimistic, and reflected in what we're thinking about the interest rates, right, should have been in the past. What has happened is basically people were thinking interest rates are not going to be increased until like 2023. Now they're thinking 2022, right? So it's the optimism that's coming back into play. So what does it mean? I think there's a couple of things here to keep an eye on. If the trajectory of the interest rate is really what matters, right? Whether interest rate is 0.5% or really 1%, does it really matter? Probably not. Right, but it would matter if it starts being 3% or 4%, right? And that's something to keep an eye on. That's going to impact valuation of growth stocks, especially because a lot of their value is in sort of the terminal value, right? And the discount rate plays a big role, which is indirectly related to the risk-free rate as decided by the Fed. Now, when I'm saying Fed, you can replace the word Fed with any other reserve bank, which has independent. If you've got an independent monetary policy and you've got an independent currency, then you can set your own interest rates and decide sort of, the level of liquidity in the market. They're also saying that you're going to reduce some of the bond buying and things like that, or start tapering down. So overall, I think something to keep an eye on. I mean, what I think surprised me a little bit is that generally when you say that the interest rate is actually going to go up sooner than anticipated, you think the market would react negatively. Here, the market actually reacted positively. And maybe the takeaway here is the market loves to have certainty than uncertainty. So, certainly, okay, it's going to go up. And more people are saying this is good news. Combine that with the fact that the economy is actually doing okay is good news. Combine that with the fact that, inflation is probably not going to run as hot maybe in the future is also good news. And then there's some, more or less full employment happening is also good news. So there's a lot of good news there with some, so that was my take really on it. Nothing special, but I think something to keep an eye on.
I think it's a bit of give and take, right? Like interest rates do impact asset valuations. They have for 30 years. I think that's like been one of the massive drivers of the stock market, even bond prices, obviously. So the Fed, I just reading an article from CNBC, the Fed sees GDP rising to 5.9% this year, and or just 5.9%, sorry, compared to 7%, which is what they forecast just a few months ago. In 2022, they see growth at 3.8% compared to the 3.3% that they previously forecast for. And they also see inflation stronger than the previous predictions. So I guess just moving ahead of the curve on that. And yeah, I mean, we talked about growth stocks being kind of maybe a potential loser from the compression of that terminal value, because the cash flows that we discount long into the future have to be discounted more effectively because the discount rate goes up. But I guess, does it really impact the way you invest in terms of, like, I know people might put you in the box of growth investor, but does it actually impact you in that way? Like, do you change the process? Or?
No, so I don't really like. I mean, I do think about valuation. Valuation is sort of the last thing I think about when I'm looking at a company. Valuation is my last consideration. It's like really at the bottom of the rung consideration for me, because I want to look at disruptive companies. I want to look at companies that change the game. And when the game is being changed, a lot can happen. So I don't really think about valuation until like I'm sort of checkboxed all the other things. The only thing I would say is that, look, this is maybe a more general, and maybe I'm veering off topic here. I don't think the market is overly expensive, right? And that's, and I don't think it's overly expensive. But I'm just saying, like, if you look at the big tech, then they don't look overly expensive, right? And there are pockets of the market. There are pockets of the market in every market, which is expensive. And one of the things I've found is that sometimes it's useful to look outside those pockets of expensive things, right? So, give me an example. Is Moderna worth whatever $100 billion plus, right? I mean, it's a good question to ask. It's an innovative company which has brought forward, an innovative drug platform. Is it worth that much, right? And there's a lot of things baked into it. Maybe it is, maybe it isn't. But you could make an argument that there are some pockets where things look expensive. Then you can ask the same question for something like Tesla, and say, is it worth that much, right? But sometimes you can look a little bit outside of those obvious boxes and look at other things that people are probably not thinking about. So that might be something to think about. Is, are there other sort of ideas that you can look for when you're investing? But yeah, in general, if I like a company, I don't really care that much about what the Fed is doing or not doing, because those companies are probably going to be fine irrespective of the Fed.
It was like during COVID. I think the game plan for a lot of investors during COVID was, if you have companies that have a lot of cash, so their financial leverage really isn't that dire. They're wide, most businesses really competitively advantaged, have good aligned management teams, like sensible management teams. That's really all you can hope for at the end of the day, because unless you move into risk off assets, so you sell positions in order to move to things that benefit from, interest rate or inflation linked coupons, there's really kind of no reprieve. You could go to term deposits, which could be a costly decision at the worst possible time. So there are a lot of things about it that basically, mean that it's probably still the best you're going to get is having good companies for the long term, at least, good companies in the stock market in your portfolio. Another thing that was interesting, just from a Fed perspective, is the move or the considerations around digital currencies. So there's been a lot of stuff on Twitter the last week, in fact, too, which is really interesting.
Yeah. So I mean, they're considering basically, whether or not they should issue a digital dollar, right? And what I think is interesting about that is issuing a digital currency is one thing, but is the rails around that digital currency that matter, right? When I say rails, what I mean is you can issue a digital currency, but the digital currency needs to propagate quickly. There's no advantage otherwise, because technically we have digital currency if you think about it, right? So if you've got Apple Pay, if you've got Google Pay, if you've got Touch and Go, then that is digital money movement that's already happening, right? Those you're not physically moving cash. So to me it's more of a rails question. If the infrastructure is there to support digital currencies all in, then it'll allow for quick settlement of funds, almost instantaneous transfer, like something like OSCO that we've got here, which allows for instantaneous fund transfer between certain banks if they participate in OSCO. Those sort of things can be very, very useful. To me, it seems like if that happens, well, one of the big things about crypto and other digital currencies is being attacked here, right? And potentially it can be also smooth cross-border movement of funds if you have digital sort of assets in that sense. If the rails exist, that's what I thought. But otherwise, I know that it's been talked about here as well in Australia and other places that are talking about going digital. So, but reserve banks worldwide tend to be thoughtful and deliberate in their movement, right? So they're not going to go into anything quickly, which that remains a question as to when this happens.
There was a great Bloomberg interview with Vitalik Buterin, who's the guy behind Ethereum, and because there's been a lot of moves in this respect lately. Jack Dorsey from the Twitter and Square fame, we've seen PayPal make a move into this. then there are heaps of innovative startups as well that are looking to break this market. So it's a really interesting thing. I think, I've interviewed a lot of pretty high profile crypto investors and from my perspective, it probably makes sense to have a small allocation of crypto assets if you do think that is the way of the future. And to be honest, I think it is too, but it's like you said, I guess it's the rails, right? It's the blockchain that underlies it. And one of the things that I took away from that interview with Buterin was that basically, even if PayPal, which owns shares in, or Square, or whoever come out with their own version of a crypto asset, it's still kind of held on a ledger that's controlled, like a private ledger somewhere. And so, yeah, it might be instant. It might have all of the safe. It might have all of the kind of the usual features from a consumer perspective in terms of instant transfers and what have you. But at the same time, it's whether or not it's truly trustless. And so if there's something like the Fed embraces something like this, then that is really a game changer, because it brings the two worlds closer together. So that's going to be something interesting to watch. I probably would add an extra thing on here, which is something I've been asked about a lot this week, which is basically what's going on in Chinese property development. I've done a few live chats this week, and they're all asking basically, is what's happening in China and the Chinese property development market something that will boil over into another global financial crisis? And the more I read about this, the more it seems the answer is no, because many of these moves seem to have been kind of set in motion quite a long time ago. And this is an instance of a very kind of lower quality property developer amongst a stack that, we're just pulling this one out as an example of, what could go wrong, but it doesn't seem to be the type of thing that can ripple over because it's asset backed and the like. With that, how have you seen this playing out?
Yeah, so I don't think this is like another Lehman moment, but maybe I have a slightly different view. So this is this Evergrande thing. They're probably the largest or the second largest property developer in the world. They're also the most indebted property. I think something like 300, 400 billion or something like that is owed by them. And I think the problem is, so this is how these things spiral, right? So these guys build residential properties let's say as an example, right? So let's say they're building a big tower in Hong Kong, and a bunch of people are going to be buying into that tower. So they're going to be paying deposits. Those deposits are then bank guaranteed. So the consumer is taking the loan from the bank. The bank is then, giving them the money. That money is then flowing to Evergrande. And now that there is this doubt, or there was this doubt, I think Evergrande has made a payment that they couldn't make their coupon payments, which is basically payments on their debt. Then that company basically goes into default. If that company goes into default and it goes bankrupt, then what do you do? Right. So if the banks stop lending money, then the consumers don't have the money to pay Evergrande. If Evergrande doesn't have the money coming in from new projects, it actually can't make payments to its suppliers and on its debt. That's the problem they have gotten into. That's the pickle they are in, right? And I think what happened is this basically example case of where basically if you took on too much debt, the only way to further get out of it was to build even more, create more properties, create more work so that you can get more cash flow coming in. But that meant taking on more debt as well. And so can there be a ripple effect? So ripple effect could be that if a bunch of properties stop, or they do fire sale on some properties, which means they take write downs. That write down then flows through to the banks who have basically a property, using the property as guarantee, right, to provide the loans. That happens. That can have a ripple effect on the Chinese market. If the Chinese market, the property market, then pulls. Slows down, that has then Chinese property market then basically is construction industry. The construction industry's demand goes down. That has an impact on raw materials, which then has a flow-on effect on things like, iron ore prices and stuff are down significantly from their peaks, right? So there can be peak, but would there be a bailout or not? Maybe, right? I think what has happened is the GFC has maybe taught governments a lesson, maybe the wrong lesson, and to some extent, which is you don't want it to happen, because if it happens, bailing out is better than letting it happen, because if it happens, then it's worse. But the converse is also true. If everybody knows that they're going to be bailed out, then nobody's going to be disciplined, right? So then you've got more bailouts to do. Eventually somebody's going to pay for it, right? So I mean, I don't know. So I don't think it's a big deal, but I think it's some deal.
I think so about $300 billion in property, with about $220 billion, $300 billion in debt with $220 billion of property basically underlying it. I think one of the key distinctions that I come across, and there was in an article that you sent through, but also some other stuff that I was reading, is that there's two key differences. I guess one is that, first of all, people have seen this coming because it has been in debt. It hasn't got this debt overnight. People have seen this coming, and based on what the Chinese regulators and the government doing is basically trying to increase housing affordability, but also trying to really kind of have strict oversight of what's getting done and where. And so it's been very kind of like under the microscope for a long time. The other thing that I'll mention is that during the GFC, basically there was like contagion and ripple effects, and when the price of property in China is going up because it's in so much demand, the actual value of the assets that they have shouldn't fall away too much. So in terms of the land, it should be pretty reliable in terms of its valuation and what it's actually going to be sold for. Whereas you look at like CDOs and those types of synthetic products during the GFC, there's a bit of difference there in terms of that spreading over, and things that were supposedly AAA rated are now not investment grade. That's a big difference. I mean, who knows what happens from here? But what I will say is that I was reading some other reports from the likes of Platinum Asset Management, which I know is pretty heavily focused in China. And they're effectively saying that, it's been the case for a while. The governments want to increase housing affordability because they have many kind of bold ambitions for younger people in particular getting into the property market in China. And there's even instances where, they're trying to develop so much in certain areas that brand new houses are selling far below kind of what the equivalent house is already selling across the road, and or has sold across the road, because they're just trying to roll out they're unlocking so much land at the same time because they need the housing. And then the final thing on that which I thought was interesting, is they're doing a lot of lotteries for housing in China in terms of trying to get people into the market. There's so much demand that they basically just have to go into a lottery, and then they get picked randomly. They have to kind of decide there and then which apartment they want if they're successful in the lottery. So I think there's still a lot of underlying demand. I think it's slightly different. I mean, for me, as a takeaway from this as an investor, it's not that I'm anti-China. It's just that I don't need to invest there directly, and I don't need to invest in property development or anything that's really associated with that. So that's kind of, we come back to the point on tapering before. You can protect yourself and your portfolio for the long term, I think, pretty reasonably. Like, sure, you'll have volatility, but you can protect yourself pretty well just by being sensible in what you own and why you own it. That's my kind of takeaway. And in the short term, I'm happy to be guided by kind of the others that do actively invest in China and monitor the situation very closely. There's one more thing that we wanted to talk about before we get to the reasons why we sell positions. And one of those is Facebook CTO leaving, been at the company 13 years, being replaced by another CTO who has plenty of experience too. So I don't know what you made of this. I own Facebook shares. I'm not too worried, to be honest, but you may have a different perspective. I know we kind of differ a little bit on Facebook.
No, I don't really. I mean, no, I think like Facebook is a fine company. I own it. I used to own it. I don't own it anymore. I mean, I have maybe, as I say, having moral issues with companies is not a good idea. It's not good for investment. But I think it's what I actually thought was interesting about this move is the person taking over is actually the person who's responsible for hardware. So this is a software company, basically an advertising company, if you think about it, that is putting somebody who is hardware focused in charge of as chief technology officer. So I don't know what I can take away from that. Why not put somebody who's responsible for your ad business, somebody who's responsible for something else, in charge instead? So I thought that was, maybe it's just a messaging that they're trying to do, that maybe AR and VR and all those things around Oculus is important, and maybe that's the messaging here, or metaverse or whatever Zuckerberg likes to call it. So I thought that part was interesting. People leave for all sorts of reasons. 13 years is a long time, right? I mean, 13 years at a fast-growing company is going to suck blood out of you. So and if you're not the founder, there's every reason for you to leave.
I think when he joined, it had a $15 billion market or valuation at Facebook, and now it's over $1 trillion. So, I mean, I think one of the comments that I saw was that maybe it's because moving into a part-time role, which is when a lot of key stakeholders remove themselves from businesses. That's kind of the politically correct way and right way to do it by long-term shareholders. But he's probably made a lot of money, like you said. He's kind of invested a lot, and now it's time for him just to move on. And that's fair. And when you're a company like Facebook, you can afford to pay engineers, very, very generous salaries. And not only that, you can pay many of them. So it's not just paying one or two, you can get a lot of them. And so you have a lot on the bench when one wants to be substituted off, you can do that. So we just had some comments on the live thread here. Julian said, my ears have been enjoying your new microphone dock. So that's interesting.
Okay. All right.
Lachlan says, so basically Evergrande is a Ponzi scheme, ?
We could say the same thing about Australian property too. It's a pyramid. Every property investment ultimately is a pyramid. If the property is going up, you can think of it as a pyramid. Okay, now watch the haters come by. So here's an acknowledgement about the microphone here, right? This microphone was kindly provided by Owen of Rask fame, and I actually love it because it actually gives a good voice.
Yeah, I actually don't, and I've actually got mine up there. I should probably get it out. I've been a sucker for these AirPods for a while. But then we got some more comments here. So we've got, and by the way, Rode is the microphone maker, that wonderful Australian business. Josh says, Ashmore, BlackRock, UBS, and HSBC own around $1.3 billion of Evergrande bonds, according to Bloomberg. So there's US exposure to this, hence the idea of contagion. Yeah, which is fair. A lot of the debt is denominated in US dollars. So that's a risk too, right? With when you have emerging market currencies and you have the volatility in the currency. Yeah.
So the bond market is, and the thing that people forget is the bond market is what, 10 times the size of the stock market. So the bond market is huge, and that's how sort of stuff can flow over. But again, $300 billion of debt overall in the grand scheme of things, where we have trillions and hundreds of trillions of dollars of debt, is probably small. But that's a good point. Agreed.
Julian then commented again and says, Facebook is undoubtedly a great business, but has ick factor for me, which is probably what I think you've talked about this in the past too. And I think that's something that a lot of people have commented on. There's been some big things over the years with privacy, Cambridge Analytica, many different things over the years that have kind of called into question Facebook's ambitions, including its own cryptocurrency. So I think that's
my thing with Facebook is, the fact that it's $1 trillion business, which is basically an app, is what makes me worry. Because if the app ecosystem is to shift, right? Various regulators are trying to break ecosystem. That is actually bad. Just equally bad for the owners of the ecosystem as it is bad for an app itself, right? So that's sort of what it doesn't control it doesn't have layers that it can control. So it's trying to do that with Oculus and things like that. I don't know how successful it'll be. It's a very difficult transition for a company which sells stuff for free. Let me put this in air quotes, free, and then get them to buy hardware from you, which is not free because they're not used to buying stuff for free, but not used to paying for stuff, right? So that's I think that's been my thing. I've been wrong about it, but from where I sold, I think Facebook has doubled. But yeah, that's okay.
Don't take your confirmation bias from price or your signals from
John,
price. Yeah,
I have
from the
to.
chart.
That's the only way I'm going to feel regret.
Yeah.
Otherwise, I have no regret about it.
And I think that's fair too. Like another criticism is obviously like the shift away from the Facebook.com app and Messenger towards WhatsApp and Instagram, and it not being as kind of not necessarily transparent, but as obvious how those businesses are going and kind of the big picture opportunities there. But yeah, they're all fair criticisms. Henry just did say, "Get the mic out, Owen. Your voice has been a little scratchy lately." Well, I've got the mic out. Unfortunately, I can't connect it to a live chat, but I will next week, Henry. So thanks for the nudge. Okay, mate. So wonderful. Let's move on to some of the key talking points. So we've got a couple more, which we'll cover off briefly. It's basically this question around when do you sell a position? Because we talk a lot about buying companies, exciting companies. We talk about all these different things around kind of the entry, maybe even the holding, but we don't talk much about when to exit. And I'm really keen. I know you've penciled something or penned something, I should say, for Seven Investing on this. So maybe you can just share a bit of that with us.
So my article, and actually all the articles of my colleagues, they're not behind the paywall, so they're public facing, so you can actually access them. Each person has their own take. So my take on selling is I sell. Basically, my selling is driven by I need the money, right? And that's really the only driver really behind. So it's not that I am actively looking at my positions. I'm not doing active management. I call my selling reactive. I need the funds because I probably want to invest in something, or I need the funds to, maybe, pay down for a house deposit or something like that. But usually I only invest stuff in the market that I don't need for a long, long time. So typically it would mean one of those things, there's some rare event has happened that means I need cash, or that there's another company that I really like that I want to buy, but I don't have funds to buy, or I've got a small position and I can't increase my position. The problem is I actually detest making this move of selling something and buying something, because I need to now get two decisions right. And I really, really detest. I try to keep that too. And I remind myself that every time you do that, your chance of being overall correct actually goes down because you're making two back-to-back decisions, right? So 50% probability of getting right, then you effectively, if you think of them as independent bets, then they become like 25% probability of getting them both right, which basically reduces the chance of being correct. But that's probably my number one reason to sell is I need the cash. And then what I do really is I just look at, and because I keep track of what my businesses are doing, I basically look at the one that is the weakest, I don't like, or has small position that I had taken. I call it my position so that I'm going to watch it, and I never really added to it. Those are the ones that go. Businesses that I have not followed closely, and I am not really keen on it. So basically, stuff that I'm not interested in, the first ones to go. Above that would be businesses that I've held for many years that are underperforming, and I'm again very hesitant to sell them because unless there's really good reason, sometimes businesses underperform stock price wise, as you said. Don't take your cues from the stock price for a long time, and then can outperform. Sometimes businesses have execution issues that roll on for several quarters and then sort of fix themselves because they have good management teams. So it's just hard. But yeah, but I would have an order where I'll cull my speculative positions first, then I'll cull businesses I'm not interested in. So like Facebook would be in that. I'm not interested in following Facebook, so that's a good business for me to actually get rid of from my portfolio. That doesn't mean that it's not going to do well, but it's just something that I'm not really interested in. So that's another one to consider. And then of course businesses that might be struggling are another ones, the other one to consider. So that's sort of my self-philosophy. It's not much of a philosophy. It's the only key thing I take away is reactive. It's not proactive. So I'm not proactively managing my portfolio.
It's interesting that you say, I've never heard that before around companies that you actually want to follow. Like I've never really heard anyone articulate that in a way that says, I sell positions if I just know I'm no longer like that's not what I want to do. It's not what I want to follow. Like Facebook is a really interesting example. I've got one more question for you, but I just want to call out this tweet because I wrote about this not too long ago for our Rask Invest service, and it was a tweet from Joe Mager, and it comes from a Bank of America manager survey, and the tweet was, and Joe's got the screenshot: what best describes your investment time horizon at this moment? And the weighted average time horizon was 7.4 months. But I think a few of them only had, so here we go. Yeah, so the weighted average was 7.4 months. Of those surveyed, 47 said they hold stocks for, on average, less than 3 months, and six fund managers responded and said, we don't know what our time horizon is.
That's funny.
So it's a really interesting one because, yeah, I mean, what it means is if you take the median there, 7.4 months, it's effectively saying when fund managers and the professionals that we pay, or some people pay, are investing only 6 months or 7 months ahead of time, there's a time arbitrage there effectively, and a behavioral arbitrage. And that just comes back to what we know about being individual investors. We don't have constraints like window dressing, showing up for the quarterly reviews, doing the webinars and all that sort of stuff. We can kind of run our own race, which is why your comment was really interesting. The one question I have for you is, I was reading your article, and one thing that people tend to do is they tend to curate their portfolio, so they are more active. And you've said here that, you know, some people sell because a position is, air quotes, too large. And you said your largest position is 25% of the entire stock portfolio, and you're okay with that, but some people wouldn't be. And you said it's like a personal decision. How would, like, at what level would it become uncomfortable for you? And how do you make that decision?
Yeah, so the largest position is Tesla, and you know, like, I think investing is very personal, right? I mean, I feel I sold some when we, bought this house. I sold some to pay the deposit, and I felt very good about it. And I almost thought I should name the house Musk. But look, I think it's okay. Like, I understand that company, and I'm fine with it. I understand the volatility that comes with it, but I get it. I get what they're doing, right? Which is again this, this point that you made about. So I'm okay with that. An active manager would look at 10% position and then have to call, because you can't go back to your clients and say, "Oh, I've got a 20% position." But an individual investor can, as long as they understand, right? Most people would say that 15% probably is a lot, and yeah, but I feel as long as I feel comfortable about it, it's okay. It's it's fine. And here's the thing though, right? What I do is I let positions organically grow. So like, the only time I've sold is, I think, last year when, last year when we were looking to buy the house, I sold some. Otherwise I've never sold, right? And so my time horizon is not that 7 months. My time horizon is 8 years, 10 years. My positions are that long. I just let the compounding do the thing for me, and I just wait. Because if a 10 bagger doubles, that's a 20 bagger. Right? That's where the magic happens, right? And as I tell everyone that in the first 5 years you don't notice it. Between the year 5 and year 10 is when you start noticing things, and then from year 10 onwards, it's magic. Because you could just be sitting on your bum doing nothing, and every year you could be making 5 years worth of like salary. Because of the magic of compounding. So compounding is magical. You just have to let it happen. Which is what you were, the point you were making is that that's the biggest advantage we as individual investors have, right? So
yeah, if you can find, see, I don't have any study to back this up, but basically my belief is that if you can find companies that have very high rates of returns on invested capital, eventually your portfolio, it won't happen immediately, and it will not be in a straight line, but over say 10 years, eventually your returns should come close to mirroring kind of the ongoing compounding of that business, provided that everything else. This is that old, is it ceteris paribus, that economic theory? I don't know how to pronounce that correctly, but basically holding all other things equal or the same, what would happen? Which that never happens in reality. But if they were the same, if your business is constantly compounding and growing its capital, eventually people will pay a higher price for that, because the earnings will go higher, the dividends will go higher, the revenue will go higher. And so that is basically where I kind of put my yardstick. If I can buy companies that are compounding at 20, 30, 40% a year, I'm sure that's before tax, then eventually my returns should be double digit as well. But it takes a long time to recognize that. And I think that's the key thing that most investors miss, is you have to give it time. Otherwise that doesn't work. So, I mean, you can still make money investing in sentiment. stretching valuations. We've seen a lot of that in the last 10 years. But yeah, I think that's fair and reasonable. I did a piece on this recently, 10 reasons that investors sell. So not 10 reasons that I sell, but 10 reasons investors sell. And rather than go like there's like intrinsic valuation, opportunity cost, all that sort of stuff, tax purposes, how many times have we had CEOs say they need to sell their stock for tax purposes? Then there's obviously like the fear and greed element. Many people use things like a director selling down as a signal to sell. Basically, some people just hit a goal, like a retirement goal. But the two that I want to call out is probably the two that make the most sense to me. They're kind of like my truths. And the first one is that it's being more prescriptive. So this comes from basically the financial planning side of me, which is many people aren't deliberate when they invest. They are kind of, they think about investing as a way to collect assets. So I wrote about this recently as people being collectors. They just kind of collect shares. They collect properties. They collect bars of gold, but whatever, paintings, whatever you're into. And that works because you're collecting assets. As long as you're collecting assets that go up in value, you're going to have more money. That's a pretty simple thing. And I think for beginners, beginner investors definitely overthink it. So just getting started is basically the best advice for them, for sure. But over time, as your portfolio grows, and maybe if you're not a professional investor like we are, maybe the best thing for you is to have a plan that says, I'm going to invest X amount of money in the stock market, X amount of money outside of the stock market. And then if things go beyond that range, like reasonably, say 10% beyond my allocation to the stock market, then I might consider trimming my lowest conviction positions and rebalancing. So I think what most or many studies show, so there's one from Vanguard, I don't know if you're familiar with it, but it actually shows that the strategic asset allocation piece around an entire portfolio, so not just stocks, I think about 90% from an indexed portfolio, 90% of the returns are basically explained by strategic asset allocation. So not tactical short-term moves, but longer-term decisions like how much bonds, how much shares. So I think that's a valid point to make. If you are going to sell, you may have a plan in place to sell, and that discipline might actually work for you. And it could be as simple as, I only want 20 positions in my portfolio because that's all I can handle. I've done some research, that's fine. So that's a plan as well. The other thing is, and I think this applies to anything that we buy, not necessarily just shares or whatever. It's actually just having a thesis, just something that you've written down. And if it's well-rounded, you can rely on that in the future. It's basically, why am I owning something? And if that why is no longer true, if it's Tesla, I think it's going to, captivate the world with electric vehicles, autonomous vehicles, and most people are going to have power walls on the wall. If that doesn't happen, if that's not happening for 1 or 2 years in a row, that would be an example of maybe then you start to question that thesis. And so you and I are very fortunate, mate, because we get to write down our theses. We have to, it's our job. But a lot of people don't do that. So I think as a discipline, that's a really important thing to get in the habit of. And then, I'm rambled, but basically on top of that, you get the Feynman technique. And if you write it down, you poke holes in your own work and you go back to the drawing board and et cetera, et cetera. So thesis, break, and I guess the top-down portfolio constraints are, I think, valid reasons to sell. That's kind of my philosophy on it.
I love
Julian,
that. I was going to say that, journaling is a great idea. That's what Owen just suggested. You'd be amazed how much journaling helps. So
Julian says, I like Doc's approach of thinking about portfolio percentage in terms of percentage of capital outlaid, then letting them run. That's cool. Yeah.
Yeah. So that's just to highlight that. What I do is I have a set of amount of capital that I have personally put, the cash. I try not to put more than 5% in any company, and then let them run.
Yeah, right. So would you, if you had 5% to put in a company, would you put 5% in one go, or would you kind of do that over a few months, or how do you think?
So what I do, I have a running tally of how much cash I have put into my brokerage accounts, right? And I would not put more than 5% of that amount into any position. That sort of like
So you're saying over the lifetime of you putting money in, or just recently? Yeah, right. Okay, yeah.
So it's like, I don't want to put more than 5% of the total, right? So if it's 100K, then 5% of that's how much a position is going to get capital from me, and then I can let it run, right? And it can keep running forever, if and that can become large or small. That's okay. It's just another way of saying that this is my hard-earned money, and that's how much you're going to get. Now go do something with it.
Yeah, fair enough. So would you say that some people who are doing it from the perspective of total value of the portfolio, maybe that's not necessarily maybe that's a different way to think about it.
That's a different way. I'm not saying anything is wrong or right. Other problem is, as you said, right? I think there's a whole portfolio. There's like an entire course on portfolio management, right? You can go to, if you go to the CFA curriculum, I guess you'd have like entire module on that. I've never read that module. I don't understand that module. I'm openly saying I don't care about that module. It doesn't work for me. I don't know what it is. It doesn't matter. So my module is, I've just put stuff into companies I like. I want to keep money in companies I follow. And I don't look at my positions and say, it should be 5% or 8%. It's 5%. Okay, 5%. That's fine. It's 10%. Okay, it's 10%. And it's very laid back. And as I said, I think the point you made is effectively nothing is going to matter that much if you just expand the horizon, right? And now, could I have done better than what I've done? Maybe. But you know what? I'm happy with what I've done, because my threshold in my family is if I can get 15% per annum, that's great. And we're not even comparing with the market, just 15% per annum, because that's like doubling every 5 years. That's a lot. And if I can do more than that, great. But 15% is good. So again, I think that's where it becomes very personal, right? I mean, that works for us and we're happy with it.
Yeah.
Why complicate life?
Yeah. And so just to confirm here, you've never calculated the efficient frontier of your portfolio?
I have no idea what even that means.
How about?
Okay, so the only thing I look at is how much my different portfolios are giving me returns on a 1 year, 3 year, 5 year, and long-term basis. That's the only thing I look at. Or as my father would say, the only thing I look at is the total value, which is actually my father has got it right. Age does help you. He says, I look at how much money I've put in, then I look at how much money I have. And everything in the middle does not matter. Because what really matters is how much you've got, how much you put in, and that's really the end result. And I'm with my father here, so that's what I look at. So just looking at returns is what I do look at.
Yeah, I can tell you the CFA curriculum around portfolio management, it's not that much fun. So you're not missing out on a lot by not reading it. Like it's sure you got to know the rules of the game before you can play it, but you can probably spend your weekends doing something else, in my opinion. But yeah, that's really interesting. And I think, again, this comes back to knowing the difference between being a private investor and being someone that is a financial advisor or even a fund manager. I think a lot of us, and I constantly remind our team of this, is, just because a fund manager writes in their letter that they sold a position, that doesn't necessarily mean anything for us. They might say that they sold it on valuation grounds, but they could have sold it for many other reasons, and that's just what they're telling you.
And it doesn't mean that the valuation is correct.
That's it. Yeah, exactly. And one of the wonderful things of being, being an expert in a field is that you can say things and your clients think, oh, that sounds rational. They seem to know what they're doing, even in difficult situations, which in some instances would probably just be smoke and mirrors. And so it's important that you make your own decision. You are comfortable in that, and not necessarily let others guide you, because if you do that, you'll end up with a median holding period of 7.4 months or less, probably. So, which is probably, as both of us were just saying, is probably not where you want to be for your long-term wealth creation. So fascinating stuff. Yeah, I really enjoy this conversation of when to sell map. I know we've got one more topic, but we're already at 59 minutes. So I don't know what you want to do.
We should keep that topic for next time, but let's do a little teaser saying what that topic is about, because that's a very interesting topic as well. So I'll let you do that. No. I want you to do the teaser. Yep.
Okay. So we alluded to this topic a couple of weeks ago when we talked about basically when you have really fast growing industries, really valuable and important industries, that could be around for decades to come, how do you identify one winner or multiple winners in that industry as early as you can? And so that's basically what we're going to be talking about next week. We're going to give you a framework of how to do those things, how to use what you know to make good security selections, so individual stocks, but also how do you build the portfolio around that? So all that and more coming up on next week's Australian Investors Podcast. How's that for a teaser?
That is brilliant. And here's the thing, this is all free stuff, right?
Yeah,
this is all free.
Okay,
Owen, one thing we didn't do is we didn't tell people how they can get hold of us. So I'm going to do the honors. You can find Owen on Twitter at Owen Rask, with the O capital and R capital. I don't know whether it makes a difference or not.
Does it make a difference? Yeah, I don't know.
I don't know, but that's why I said O capital and the R capital. Come and talk to us on Twitter. Give us ideas. We love, and have questions. Send them to us. We love chatting with people. Mine is at 7A Mahanti. You want to point them to something that's been happening in the Rask world, where they can find the Rask content, how they can access it?
Yeah, sure. So you can head to www.rask.com.au/subscriptions if you want to see what we write about, see what the Rask analyst team puts behind the paywall, which is stock recommendations and podcasts and a few other things that we put in there, including, reports and guides. And we actually released one last week, which was an investment portfolio guide. So basically, it's like a 15-page checklist for you to self-assess your plan and your goals for long-term wealth creation from the stock market and how you're going to go about doing that. So that's pretty cool too. That's behind the paywall though. How about you, mate? Can they go to 7investing.com and find out more?
Subscribe. Yeah. And so here's if you subscribe, you get what's behind the paywall. If you don't subscribe, you have lots of podcasts and articles like the selling articles in each one of my colleagues. So we have 7 advisors and 7 investing. You can find each one's how they handle selling. We put these articles out, just general, articles for people to read. Lots of podcasts and things that we do out there. And if you want to look, our recs come out on the 1st of October. There'll be 7 recs out. I'm quite excited about my own rec. I think it's a very interesting, and I've found another small, fast-growing company which is profitable.
What are the chances?
The chances are very low, but yeah, I've been actually
profitable.
Profitable. It actually has net income. so I love those when I find them. They say, "Oh, okay, there's net income here. That is pretty cool." It's a small, fast-growing company. If you're interested, then that's going to be behind the paywall. But yeah, I'll do a shout out. Actually, what Owen manages a team of really crack analysts. And some of them are really young, but they are smart and they're really cool. So yeah, check out what they're doing.
Thank you, mate. And likewise.
And I like some of them. Some of them I've at least had the pleasure of working with at least one of them, and she was a crack analyst.
I'm sure she appreciates that.
Yeah. So we'll not put her name out because we haven't taken permission from her to put her name out. But yeah, that's it. That's it.
Wonderful. Always, mate. Always a pleasure. So thank you for joining me, and I'm looking forward to doing this next week.
Yes, same here.